Hey, welcome to the live stream. It's Tuesday after the markets closed on August 19th. And if you own some of the big caps, you're feeling it. You felt it today with Nvidia dropping 3.5, Meta dropping 2%, Broadcom dropping 3.55. And it's interesting how the market really sold off these huge caps that have really over the last 3 years. These have been where investors have made a lot of money. Yet a lot of the smaller names, you see a lot of green kind of as a surrounding decoration around those big reds. It was fairly green. I'm looking at healthcare, and boy, it's had some horrible months, if not a couple of years, and it had a pretty decent day today. Industrials did well. Consumer staples on a day like this when the market's afraid, it did really well. Real estate did well. But these big caps, this is where I think a lot of portfolios are going to be hit because there's so many investors in these stocks. Netflix went down. I mean, these are all like the name brands, and they were sold off. The other thing I'll point out is we've been tracking these software stocks. Adobe CRM was up. I don't consider Uber a big software stock. I think of it as more of as a industrial kind of a company that provides transportation for people. But that's just my opinion. So overall, it was a mixed day. I don't see days like this all that often, and where you have the big caps selling off, but it happened today. Interesting. Now, is this the beginning of a longer lasting sell-off? I don't know. I think it's certainly a day that catches my attention when some of these big caps sell off like this. This is a lot of capital leaving Nvidia. 3.5% on their market cap is upwards of $150 billion leaving this stock. So that's a lot of capital leaving and trying to find a home, maybe going to one of these safer stocks or going into bonds or cash. It's going somewhere. Warren Buffett had a good day. Berkshire Hathaway went up 1.42%. And I've been covering Warren quite a bit over the last couple of weeks because he's buying into some new stocks. He bought into United Healthcare, which was good to see. I think United Healthcare got a couple of new super investors investing in United Healthcare, including Michael Burry and David Tepper, making it a total of 19 super investors in United Healthcare. So the Oracle from Omaha has gotten into United Healthcare. He also got in a couple different positions in his portfolio. So he's making some moves. Might be a sign that certain industries are providing bargains, as he would state it, and he's willing to make investments. All right. So today I'm going to focus on some of these big caps, look at some of these stocks. I'm also going to look at some stocks that sold off quite harshly. But as you know, this is a stream and I take the viewer request. If you're a member and you want me to look at a stock, please put it in the chat. I'll take a look at it. We'll do a review of the stock, evaluation, and see if that stock indeed is a discounted stock and is a bargain or if it's priced too high. If you're not a member, would like me to look at a stock, be happy to do so. Just buy a super chat, $5 super chat, and we will analyze it. Looks like Brucey is on. You want to take a look at Wix. That's the website company. Happy to do so. Good to see you. Good to talk to you this morning. So we'll take a look at Wix. Just a quick, first, a thank you to all the members of the channel. We've had a big increase of members on the channel. I really appreciate that. And if you haven't done so already, please get me your email address by emailing me. And I put my email address on the chat. Look me up, send me an email. I want to make sure you get all the perks. Saeed, good to see you. Hopefully you're doing well. Um, Kareem Biggins, what's up, man? Good to see you. All right. So now let me talk about methodology. How do I look at stocks and what type of point of view am I addressing? I'm a long term investor. I'm not looking at technicals. I think technicals are interesting. It's good to see what the market's doing with a stock. I'm looking at a company's overall place in their market. Are they a desirable business? Do they make a lot of money? Do they have high gross margins? Are they growing their top line revenue? If you keep answering yes, yes, yes to those questions, that means that company is a good one. And the important question is, are we getting a discount? When we look at that stock, are we getting a discount if we buy today? If not, maybe we have to be patient and wait a while. So I'll go through those pieces of the overall methodology and arrive at, hey, it's today, would that be a good buy? And sometimes some of these quality businesses, you got to be patient, wait for the market to sell off. Sometimes the market just doesn't understand a stock. Maybe there's stories out there that are reducing the price of a stock. And when those stories are proven to be inaccurate, those stocks really go up. So that's the kind of investing that I do. And that's the point of view that I'm going to address. So let's get into it. All right. So we're going to go over Wix. Wix is a platform where businesses can go and create their websites. It's a really easy to use studio. You can go in there if you're a small business, within a day or two, you can get yourself a nice website. It'll look elegant. They have nice templates and you have a professional looking website. So that's what they do. I've known of this business for a while. And the one thing I would say is I'm surprised. I've looked at it a year ago, 2 years ago. I'm always surprised that they don't make more money. Just put it out there, frankly, because I know other businesses that are in their space and some of the other businesses make a lot more money. But let's see if maybe things have changed. The stock sold off 41%. Holy smokes. For the 1 year, it's only sold off 22. But this year, what is going on? We're going to look at revenue and see if maybe that's telling us that, hey, these guys are losing momentum. Maybe they lost momentum and they're ready to move on. Or, excuse me, the market has moved on. The market cap for Wix is $7 billion. Revenue is $1.87 billion. It's not bad. That's pretty nice pricing on a price to sales. PE is a little high at 45, but next year it's going to come down to 19. That looks pretty good. Analysts are saying it's really discounted. So I'll take a look at that in a bit. All right. So we've got revenue. Top line revenue is looking good. 13% growth is good. It's almost a $2 billion business. So that's some pretty good growth. And the growth here is there. And I know, Bruce, you asked about this. So do you know if there's a story out there that is ailing the Wix stock? Is it some story out there that, hey, AI is going to destroy the Wix business? Or is there something out there that's ailing the stock? All right. So revenue growth of 12.44 in the quarter looks really good. Okay. All right. So I'm good with that. Let's keep moving. So when we get to gross margin, 68%, and they have grown it. Nice job, Wix. Looks good. And then we've got free cash flow. Man, this free cash flow is looking good. It's grown nicely. $551 million of free cash flow. I like where they're headed. And it makes sense, right? Wix is providing something that just every business needs, just a simple website, and you're good to go. And these guys provided at, I think, a rational, reasonable price. I've looked into it and became familiar with it. So now they provide the same thing. What I like about software companies is they become really profitable and generate a lot of free cash. And these guys certainly are looking that way. All right. So they're growing at 12, 13%. Let's take a look at their balance sheet and then what analysts are saying. So I want to make sure on balance sheet. The balance sheet is just, I don't want a company with a bunch of debt that's just going to be a bag of problems. And these guys have $1 billion of debt and cash is 1.1 billion. So they have a little more cash than they do debt. Very good balance sheet. These guys can pay off debt immediately. Looks good. All right. So that looks good. Balance sheet checks off. Let's take a look at the forecast. 19 analysts cover it. That's a lot of coverage. Some analysts are really optimistic. $255 price target, pretty much double your money if you listen to that analyst or if you believe that analyst. And the most bearish analyst is at 166. So everybody thinks this is priced too low. Okay. Let's take a look at their forecast. So a lot of analysts are weighing in on the forecast. They're supposed to keep growing at this rate. That's a very good rate of growth. Looks good. And their earnings per share are going to expand faster, almost double the top line revenue growth. These numbers are looking really good. These numbers are looking fantastic, as a matter of fact. So fantastic numbers. Let's build a valuation with Wix. And I'm going to look at the Wix data on a screen you guys can't see. But I'm going to put it on another screen. I'm going to start a valuation on Wix. All right. So we could just use Snowflake. It's not exactly the same company. Actually, I have Shopify in here. Let's put it next to Shopify. Shopify is the biggest company doing things like this. Shopify is more of a full online store. Wix is more like, hey, you're a law practice and you're just want to present yourself professionally online. Okay. Wix is your provider. You don't need a full website where you can order, and have a shopping cart and have payment systems and all that stuff. That's Shopify, but it's kind of in the same neighborhood of technology. So we'll kind of use that guy as a starting point. All right, so we'll put Wix in there. So Wix smaller than Shopify, so I'm going to go with a discount rate of 9%. You increase that discount rate if you feel like you're taking a higher risk. And with a smaller business, you're always taking a higher risk. All right, so let me get cracking on the fundamentals that I want to put into this analysis. Just a second, having a little trouble with my screen, but I'm back. Okay, 551. So 551 is the run rate, the trailing 12 months. And they're growing at 12%, 13%, but their cash flow is growing faster. So I'm going to give them a 14% growth rate. And I think they're going to continue to grow nicely into the future because they're small. So we're going to take this number. We're going to take their trailing 12 months of free cash flow, which is 551 million. We're going to grow it by 14% in year one. And we're going to grow it by 14% in the first 4 years of it, I should say in the next 4 years. And then terminal value is going to grow by 5%, discounted by 9. And then that'll give us a net present value of all that cash that's coming out. 18 billion. All right. And I looked and saw that they had more cash than debt. So they had a little over $1 billion of cash. And they have 1 billion exactly of debt. So they have equity value of 18.4 billion, which is basically the net present value of cash plus of cash flow plus the cash on hand minus debt. All right, market cap. Got to update my share count because that share count is not correct. Shares outstanding 55 million shares. So put 55.9. And we've got the stock prices. So you see a big discount. So I'm agreeing with these analysts. They're saying, hey, this stock's really discounted. They're saying it's discounted by 69.67%, and cash is supporting a higher stock price. So let's take a look at earnings per share. Analysts were saying that they expect the company's going to do, man, those are big numbers, $8.67 in the 2026 year, and it's growing nicely. Oh, sorry. So PE, man, they're getting such a low PE. And I'm going to show you like Shopify, which is just above it. That's why I put these together. I put a PE of 36. And if you look at the stock market, it's giving Shopify a PE of like 70. Well, why not give a very similar company a PE of like 24? That seems a little more rational than keeping it at, currently they're at 17, moving to 14. That's irrational. So this sucker is discounted. This is a discounted stock. Now, the thing I like about Wix is they're not trying to do all things for everyone online. They're trying to stay in their lane and just do, professional websites really well. So Wix is looking good. Looking very good. Now, when I've looked at this stock in the past, I think I mentioned in the past, I just didn't like the pricing. And I probably didn't like this price at 235, but now that it's come down, I like the price. So I didn't like it here, but I like it here. The price has come down by 50%. So it's looking really good. When did they announce their earnings? August 6th. So they announced, call it a week and a couple of days ago. Since it was so recent, looks like the stock sold off. Did they give guidance that wasn't very good? So yeah, this thing looks good. The fundamentals are strong. I know what they do. This to me is a good stock to consider. So Brushy, this is a good looking one. And I'm going to follow it, put it on my watch list, see if this sell-off is really, really wicked. Might be good to pick up some Wix shares. So thanks for asking, Brushy. Looks like a good one. And, the market will do this. It'll sell off stocks, drastically. I can show you example after example. And the smaller they get, like this is a $7 billion company, the market sells off small caps even harsher. So, all right, we got through Wix. Now, I think the next stock is going to be XP. All right, so let's take a look at XP. XP is a financial services company in Brazil. And man, they sold off really, really harshly. They announced yesterday. Now, their announcement, I did look at it and I was underwhelmed by their revenue. Okay. Now, this is down in Brazil. A couple of things that I like about Latin America from an investing perspective is they have a market that I consider more fertile. And what does that mean? These guys are providing financial services. Here in the United States, we've had financial services, forever. You can get life insurance, you can trade stocks, you can get all kinds of stuff, buy insurance, no problem. Now, in Latin America, there are, people that are entering the middle class and they're buying financial services, for the first time. Maybe it's the generation that's going to college, taking a more professional job. Maybe somebody started a business and they're like, hey, I would like to invest in stocks. I'd like to buy insurance for myself because I have a family. All those things, that family or that person didn't own that type of service in the past. So when I think about Latin America, I think that the market has two tailwinds. One, it has growing population. Two, you have a part of the population that's entering a market. In the case of XP, it's financial services. So I like those two factors, but this revenue is not growing. That is not good. So it kind of leaves me thinking, well, what's wrong with this business? Let me show you DLO. DLO is down in Brazil. And I just want to show you from a comparability standpoint. They're growing at 22%. And you see how they accelerated out of that particular trailing 12 months. In the last quarter, they said, hey, we grew by 49%. Now that is impressive. These guys are doing business down in Brazil. So back to XP. What's the matter, guys? You're not growing. What's the problem? You should have plenty of addressable market. So the market selling off harshly is a combination of two things. One, we had a sell off. Okay. We had a lot of stocks sell off harshly, right? And when it comes to XP, I don't think the numbers were all that impressive. I think they have a solid business, but they're small compared to other businesses, right? This is actually, this is in the Brazilian currency. And if we go BRL to USD, it's 0.18. So when we look at these numbers in our head, I guess in my head, I'm going to do the math. This is probably about 3.2, $3.4 billion in revenue. So it's not like humongous. It's not like, oh my God, it's, $50 billion. Of course, it's hard to grow. No, it's a pretty, it's a solid number, but it's not huge. All right, moving along. Now, these guys, they have good profit, good margin. Their free cash flow is really off the charts. And I use that free cash flow, but I'm a little concerned about this stock. I'm currently not in XP. And the concern is on this line. The top line revenue, again, it tells me our customers, more customers coming to this business and buying their products or services. Are existing customers buying more? Does this business have pricing power and raising prices like a Netflix or a Spotify? You hear them, hey, they're going to increase the subscription on Spotify. And everybody keeps their subscription and voila, Spotify is making more money. Netflix does the same thing and voila, they make more money. That's called purchase or pricing power. The customer likes the service so much, they can do that. I'm not seeing that with XP. I'm not seeing that they're growing the number of customers. So I think that was the biggest problem with their earnings. That's why it's sold off. Now, it's always hard to figure out, is it more of the market condition or the stock? Well, going down 8.57, I think under any condition is bad. But I'd want to see this thing trade, and I'd want to wait. For me, I'm going to wait until these guys report once or twice again, maybe 3 times, and they have to start growing more. This isn't going to work for me if they can't grow faster. They have to grow faster. Other businesses like DLO, and I think Mercado Libre is doing a lot better. Mercado Libre is down in Uruguay. They're growing at 33.85%. They have a bigger number. This is in US dollars. So this is like more than twice as big as XP, and they're growing at a really nice clip. This is what I'm excited about. This is why I'm in Latin America. Now, I don't have a bunch of stocks down in Latin America, but This is one of them. They also have a payment processor. And look how they held their stock price today. Even though it was a sell-off day, it only went down 0.89, which is different than XP. So I wanted to provide kind of some comments around XP. So hopefully you find that interesting. I'll show you my valuation, but again, it's, investing is qualitative and quantitative. It's an art and a science. And let me explain after I pull up this screen, and I'll explain what I'm talking about. So the numbers look fantastic when we value the free cash flows of the business. So this is quantitative. I put these numbers in a model, and it kicks out that, hey, this is discounted. But let's think more qualitatively, like, hey, do I believe in this business? I think that's a very important decision you need to make about businesses. If you can't have that type of judgment, you may not want to be in that industry or that stock. You should be able to say, hey, XP, am I a believer in this business? Now, I understand financial services, especially here in the States. To some extent, I understand Latin America, but I'm not going to claim to know everything there is to know about Brazil. They do business in Brazil, Mexico, and Colombia. But that revenue growth is what pulls the rug from under my feet. I'm not a total believer if they can't grow, because the other factors around XP are pretty good. That, hey, you have a big population, you have people that want to, buy into financial services and so forth, but they can't grow their top line. So that's why I'm out. I'm like, qualitatively, I just don't feel 100% sure of XP. I feel better about Mercado Libre. DLO, I don't own DLO, but obviously the numbers they put up, DLO just went up like a rocket because investors, I think, felt that way about DLO. So those are my comments on XP, and we'll watch it. When you invest outside the country, I'm in the US, right? And you see this discount rate, 11%. We increase discount rate when we're taking a higher risk. And in the US, I understand business as well. I understand the laws. I understand the reporting standards, all that good stuff. And I could probably form better qualitative decisions on US stocks. I leave the country, I'm taking a higher chance because I have less of a knowledge base. And that's why I increase discount rate. That's why you want to increase it, because you're taking a higher chance. So, all right. So let's move on from XP, and we're going to take a look at Intel. Man, it's not the funnest thing for me to talk about Intel, because I just think in a way they're like a dumpster fire. And I have to admit, I lost money on them, and I'm a little sore at them because I think their previous management team, their CEO, he did not have a partnership with stockholders. Stockholders are owners of the business. And, if there's bad news to be communicated, you need to communicate it. Even though it's going to be a tough day, week, month, whatever, you need to communicate to your owners. And the previous CEO did not do that. He's out for good reason. Now they have a new CEO, but it's almost like Intel damaged its relationship with investors like myself. Now the stock's going up because there was a deal made where the federal government's receiving part ownership in Intel. Yep, equity, because they're allowing Intel to, I believe, export or. So the government buys so much from Intel that they're asking for equity in the company. Now, there could be some good logic behind it, which is Intel semiconductors make their way into a lot of military equipment. And the government may say, look, we need more control over you if we're going to give you more government contracts and so forth. I could see that. But Qualcomm, which is, I am a stockholder of Qualcomm, a different semiconductor company, they go do a lot of business with the military, and they don't have that type of arrangement. So this thing's a little bit of a undesirable. I don't think it should happen. But Intel's, really in a real pickle. Their business is kind of broken, and they're just trying to find a way forward. I mean, look at this stock price. It's down 48% over the 5 year. This just killed investors. Investors that believed in the company. Intel, this was one of the most valuable, important businesses on the planet. When we had the era of people, households getting PCs, it was Intel semiconductors that were in those PCs. This is a huge success story that I thought was going to come back from, a couple years of bad performance and come back to the era, or I should say, the level of performance and respect that the market would have on Intel, but it just never did, and it just got worse. They started to lose credibility with the market, didn't have a good relationship with investors, and now they're at this point. Looking at so that's what happened today with the big, increase in Intel. Their revenues, they have a big base of revenue. Let's face it, I'm on a PC that has Intel semiconductors in it, and I bought this PC, I'm going to say about a year ago, and I have a laptop that has Intel in it. So Intel's in a lot of product. $53 billion of revenue is good. And they're not growing it, but they're not contracting as fast either. They were bigger. Look at that. They're 53 now. And in 2020, there were 77 billion. And they've lost $26 billion of top line revenue. That's a lot of loss. That's a lot of revenue being lost. So they have, let's take a look at their gross profits. Gross profit. See how it went from 56, 55, 32. This business is ill. It just has a lot of problems. They lost 22, 23 full percentage points of gross margin. Something's broken. They have to discount their product so much. They have to give away their product. Remember how I was making the point about pricing power? Netflix has it. They can raise their prices. Intel is such a basket case that has to decrease its prices in order for customers to buy. That's a very weak posture for the company. So that's going on. If they can increase it back to 55, man, everything's going to get better. Look at the cash flow burn. Oof, horrible. They used to produce just gobs, mountains of cash. $21 billion of cash in 2020. Now they burn $11 billion of cash. What a turnaround, huh? A turnaround in the wrong direction. So Intel, man, it's not the kind of stock I like to invest in, because you're kind of investing potentially to make some money in the near term. And I just don't find Intel to be all that predictable. And for now, I'm just staying out of it and cannot price Intel because they burn so much cash. I'd probably give them a really low valuation. I wonder what analysts are thinking about Intel. So we have an analyst that's saying it's worth $29 a share, and an analyst saying, yeah, this thing's going to go down to 14. The analysts together consensus is that it's priced too high. Well, today it went up quite a bit. They're supposed to start growing. That would be a turn in the right direction if they start growing. They also got to make their way into the data center and get a part of this, very fast growing AI market. If the AI market can be something for Intel, I think they can make something out of that and probably improve their business substantially. So that is Intel. All right. So we covered a couple of stocks you guys wanted to talk about. Let's keep rolling here. So it looks like we've got a lot of people on. Let me say hello to everybody. So Brushi, Saeed, Kareem Biggins, Kurt, good to see you. So I covered XP. Hopefully you found that interesting. Ibrahim, very good to see you. You're a software engineer. Yeah, I can understand the website easier to make with AI. I can understand that. But you still have to host it, right? And I think Wix does everything in one. You make it easy, literally a professional, whether you're a dentist or a attorney or whatever, you can create a website on Wix and make it look professional. You don't have to hire an IT guy or gal. Like, you just create it. But I agree with you that AI may change things there. All right. So I think you guys agree on Intel. TSM. Let's see here. Hold on a second. So it looks like we're going to cover SEM. Now, was TSM up there? I see TSM as a ticker. So Mitch, good to see you. How you doing? Select Medical. Yeah, Brucey, you want to look at TSM and then we'll look at SEM. Good to see you, Mitch. Mike, the dividend investor guy. I can't have too many days like this in a row. Okay, well, let's put that in the suggestion box for Wall Street. But we'll see. I mean, all kidding aside, a day like this is like, okay. We can see. I mean, what could make the stock market rise, right? We don't have any big earnings. That's not going to do it. I think we're all. I would say the market's a little nervous that the Federal Reserve Chair is going to speak on Friday. And I think that's going to be really looked at. The big news, and I think there's just too much drama in that whole thing, is what is his view of the economy, which is important because I think he really does have a very good view of the economy. So I think that'll move the market. If he were to come out and say, hey, the economy looks good. We have everybody that wants a job can get a job, and we're going to be okay on that front. We've been reluctant to decrease interest rates because the economy is so good. All right. Well, the market might rally on that because the market's going to hear the economy is good. Now, if you were to say the economy's bad, we're going to lower interest rates and we're actually going to accelerate the reduction in interest rates. It's good news, bad news. Lower interest rates, mechanically, quantitatively help small caps and so forth. But the big picture is worse, which is, economy's bad. Businesses are going to suffer. They won't have as much money to advertise. They're not going to have as much money to do all these things they'd like to do. So that speech, I think, is going to move the market. And I think the market between now and Friday may sell off quite a bit. We'll see. We'll see. All right, let's keep moving. Good to see you, Mike. All right. And then, Mike, you have a position with Dave and added some LFMD. Very cool. And Brucey Wix can also use I agree with you that the whole, AI could be used to make it easier to create a website. Yeah, totally. I agree with that. All right, let's keep rocking. So we're on TSM, Taiwan Semiconductor. I like Taiwan Semiconductor because I made money with them a couple of years ago. And they are a solid business. This company a long time ago decided, hey, we're going to really focus on being the foundry to semiconductor companies of the world. And they become the most dependent on foundry on the planet. They're building a big foundry here in Arizona outside of Phoenix and getting that onshored. So year to date, 17.83% gain, 33 over the 1 year. That's looking good. 5 year. Remember how we were talking about, hey, you got to be patient with these stocks because sometimes they get discounted and then you want to take advantage of that. Quality businesses get discounted. You just have to be patient. You have to pick your spots. This is a very high quality business that I really like. So this is a $1 trillion market cap company, $116 billion in revenue. PE looks rational at 24, forward P 23, strong buy 11% discount. Now, when we look at their growth, okay, top line, this is in the Taiwanese currency, TWD, but the percentages are the same, whether we were looking at it converted into US dollar or we keep it in the currency. This is a big business and they're growing at 39%. That shows that it's a very healthy, booming business. Semiconductor is cyclical, but the advantages that TSM has is they're the foundry of the world. And right now, AI is super hot. The data center getting GPUs super hot. Everything going to the data center is just in high demand. And maybe other areas like phone sales are kind of flat. And other products like cars, the sales of cars are kind of flat. So the semiconductors going into maybe some other products aren't doing that great. But TSM doesn't necessarily have to be in the right markets because they cover all markets. Everybody that needs semiconductors can come to TSM. They will be the foundry to the world. That's how they can sustain their revenues and avoid. Sometimes semiconductors have this pretty dramatic cyclical cycles. Like they have a couple boom years and then a drastic downturn. Well, TSM avoids those. That's why. Their growth at 39.48% is excellent. And I have a valuation on TSM, I believe. If not, we'll create one. Free cash flow, this is in the Taiwanese currency. And I'm going to kind of just show the growth rates and then go to US dollars. So there's the cash flow. It's grown nicely. Upward chart looks good. Profit, gross margins 58%. Now, the reason they're not 85% like NVIDIA is TSM's actually doing something. They buy these really expensive machines. They operate those machines. They hire people. They put materials into the process, a lot of maintenance and so forth. And that's why their gross margins aren't as high, but it's still a very good margin. So when we look at, if you're ever on this site, this converts it to US dollars. So this is my way of kind of getting to some quick numbers. So the cash flow per year, operating cash flow is 73 billion. CapEx is 41 billion. It's all those, the foundries require a lot of CapEx, but they come out with $31 billion of free cash flow. Okay. So it's still a good situation for TSM. So now the point of view I take on these stocks, right, is I'm putting myself in the position of, would this be a stock that would be a good buy for myself? That's always the kind of point of view I'm taking. And that's the kind of like the answer, the question I'm trying to answer for myself. Let's take a look and see. I think I have TSM. I do not have TSM. I've had it in the past, but I don't have it currently. Let's build one real quick. We're going to go to Qualcomm, which is a stock that I own. Qualcomm does have, it's a full-blown semiconductor company. I believe they do use TSM as one of their foundries. And Qualcomm has better margins because they own the intellectual property that is the design behind their semiconductors. And so here's Qualcomm, but we're not going to look at Qualcomm. We're going to look at TSM. And this is, I'm just going to call it TSM. We know it's Taiwan Semiconductor. Now, this is one thing I'm going to increase the discount rate just a little bit. Now, I don't know how much to be concerned about it, but, you know, if China woke up one day and said, you know what, we're taking Taiwan back because they think it's a territory of theirs, boy, it's going to put TSM in a pickle, right? They're going to be like, oh man, what do we do? So I'm just going to increase the risk a little bit. It's out of my home country. TSM's a good company. And I think Taiwan-US relationships are really good, but it's the whole X factor is, man, well, what if China decides, hey, we want to take back Taiwan? I think that's going to create a lot of problems for TSM. So like I did on the other valuation I did, I'm going to open up the fundamental data on TSM and another screen that you guys can't see. in order for me to update some numbers on our valuation, then we're going to crank out a valuation and say, what is TSM today? What is it looking like? Would I buy TSM stock? Now, these guys are growing at 30%, but I'm not going to grow cash flows I'm going to grow them at 20%. And then 4%. Yeah, it looks good. And we're going to use trailing 12 months, and we're going to grow it by that 20%. And when we put together a forecast, it's as if we're looking forward 12 months. Okay. That's how I've created this model. That's how we should be forecasting, because what we're looking to do is buy this stock and let's say we bought it tonight and after hours. What's it going to do going forward? Well, if it has a forecast and it starts really growing, you better believe the stock's going to perform. The market's probably going to love what they're seeing. They're going to raise the stock price because you're going to be buying into this stock and wanting to be a part of TSM. So you see these gobs of cash. Whew, that's a lot of cash. And then terminal value is 4%. So it creates a very valuable intrinsic value. This is the net present value of all those cash flows. If you don't understand what net present value is, NPV, I was going to say Google it, but of course now everybody has AI, right? Go to ChatGPT, go to Gemini, explain net present value to me and how do I calculate it? Why is it important? It's one of those principles in finance you have to understand. Part of my goal of my channel is to help everybody get better. Every week, every month, you get better. You have to master understanding net present value. Must do it. It's like playing, let's say you played baseball and you don't know how to catch a baseball. That's just not going to work. You got to learn to catch a baseball. That's just one of the fundamentals. All right. So let's look at how much cash do these guys have on hand on the balance sheet. Man, you're going to like this number. $90 billion of cash on the balance sheet, and they owe $34,640,000,000. So they have a lot more cash than they do debt. So that equity value is looking good, looking real good. Let me update my share count because that share count is for Qualcomm. So shares outstanding, 25,930 shares. Okay. And this was a hard-coded number. That looks good. Okay. So I think I entered a number in the wrong place. So let's hit the old undo button and start over again. So shares outstanding, 25,930. So 25,930. That doesn't look right. So one second. With these foreign companies, sometimes the conversions come over inaccurately. And that's my problem here. So okay, got it. Cut. All right. So right now the market cap of TSM is $1 trillion, basically. So there's about a 16% discount if we look at the value of their cash flows. That's using a discount rate of 8.5. It's outside my home country. I have to tick it up because it's outside my home country. Let's take a look at the forecast and see if we can look at earnings per share value, and then we'll go from there. All right, so I'm going to use the 2026 numbers because we're more than halfway through 2025. And the earnings per share, and is this, yeah, this is in the Taiwanese. So I'm going to have to convert that. So we're going to go. Okay, so this is that number. Okay, perfect. So we're going to go with 71.59. That's 238, $2.38 per share. Now they're growing nicely, very nicely. They're in a strategic industry. So let me go with 2025. Grow at 20%. And that growth rate might be a little too high. Yeah, they're not supposed to grow that fast. So the earnings per share that they currently have on their stock price for this year is 114. That's really high. The one that the analysts are using for 2026 is 98. That's way too high. I'll go to 36 and that's it. So this stock here, in my mind, it's fairly priced. There's not a lot of money to be made here for me. And for me, it would be a pass. I don't want to take this much risk and end up just having my money sit around. I need a stock that's really going to move. And right now, I think Qualcomm has a very good proposition, discounted by 46%. And you look at the cash flows. Qualcomm is producing about a third of the cash, and they have about a third of the market cap. Their growth rate is good, but their earnings per share is better, much better. And that's because they have better margins. They control the intellectual property behind their product. They have pricing power, all those things. So for me, TSM is a pass. It's not good enough. Maybe if TSM were to be sold off, kind of like the way Wix was, well, then maybe we got something, if sold off by 35% and you're offering me a 30-40% discount on a solid business like TSM. Yeah, I'll take that deal, but it's not a bargain at the current pricing. So that's TSM. It's just not there. And just remember, keep reminding yourself, is the market expensive or cheap? It's expensive. We don't go up these charts like this and end up with a conclusion of, oh yeah, the stock market's cheap. No. If we were in 2022 and we were just going through this, ringer of stocks selling off, maybe here we could say, oh yeah, the stock market's cheap. Absolutely, it was cheap. But right now, after it picked itself up and it's up 76% over the course of, call it 3 years, we're in an expensive market. We have a higher likelihood of stocks selling off in general than for them to continue to rally. Now, we all like rallies, right? We love seeing our stock prices go up, but that's just where we're at. So we just have to remind ourselves, do I want to pay fair price for TSM? No. I need to find a good bargain out there where I can make some money, where I can accelerate the growth of my capital. I worked hard for my capital. I want it to sleep. I want it to work 24/7. When I'm sleeping, my capital is working. On the weekends, it's working. It's working 365 days out of the year. But I got to pick the right stocks that are going to perform. That's my job. All right, Select Medical, SEM. Healthcare's had a couple good days. I don't want to jinx it, so I'm just going to say it's a breath of fresh air. Now, this is the kind of stuff you buy. We just left tech. Tech is like super expensive land. It's like, holy smokes. It's like eating lunch in Tokyo. You pay $55 for a cheeseburger and a drink, or New York City. Super expensive to eat there. Well, this is, my kind of place. This is like Taco Bell pricing. Market cap, $1.6 billion market cap. Revenue, 5.28 billion. So you're paying a fraction of revenue for the company. Wow. Net income makes money. PE, boy, does that look rational. 12 looks good. Analysts are like, man, this is so discounted. 93.95. Man, that's a discount. It's a buy according to the analyst. Year to date, this stock's been going down. 1 year, 61%. What happened? Man. So what do these guys do? Select Medical Holdings Corporation, through its subsidiaries, operates critical illness recovery hospitals, rehabilitation hospitals, and outpatient rehabilitation clinics in the United States. So they own hospital properties. So this is a healthcare company. They own medical care facilities. I consider these guys a little bit like a lot like a real estate company, right? They own a hospital, they operate it. Now, recently, with the big bill, right, they're taking dollars away from healthcare. And those dollars are going to affect a company like this, because oftentimes the law of the United States is somebody walks in and they need health, medical help, you have to provide it, whether they have insurance or not. And sometimes these hospitals will lose money on that patient. And I think the reimbursement to that type of scenario went down. So that's going to hurt them a little bit. Right. We understand what their business is, but boy, this thing's discounted. Let's take a look at what their cash flow looks like, what their operation is looking like. So these guys are growing. So they're growing their revenues. Interesting. So I want to know something that's very important is these kinds of these businesses will grow by acquiring additional properties. And that's really important to know, because in my book, it's not as good as if you acquire another property and it bumps up your revenue. It's not because customers love you and they want to buy more, or you operate so well, you're out competing your competitor and grabbing more market share. It's because you acquired somebody, which may be good, but it's just not as good as growing organically. So I'm going to check that on their website in a little bit. They are profitable. Gross profit is there. Okay. And they have free cash flow. Good. Gross margins are low, as expected, right? They're operating hospitals. They're not like, Qualcomm or NVIDIA that sell semiconductors. Now, their gross margins have dipped a bit. In the past, they were around 20, 21, and they've dipped, especially during COVID, right? There was probably just a lot of stuff going on trying to get over COVID there. All right. Okay. So that's where we're at there. I'm going to go right to their website, because I think their financials are going to tell me if these guys are more of a real estate company. I think they are, or they're a company I could consider more of a services operator. So let me find their investor website and then try to get a hold of their financials. Okay, so this has financials. Good. So these guys are in Mechanicsburg, Pennsylvania. So just in the quarter, they increased by 4.5%. Okay. There's some kind of transaction here. There's a company called Concentra that They bought out this company. Maybe that's the property I was referring to that they probably acquired, or a number of properties. Okay. They pay a dividend. And they're going to rebuy back shares. That's a good idea. So they reaffirmed their guidance. Okay. Revenue is supposed to be for 2025 between 5.3 billion and 5.5. Okay. All right. So here's revenue. So here's revenue, cost of revenue. So there's probably going to be a lot of depreciation there. Okay. Their profitability did go down from 77 million down to 40. This is the 6 months. Okay. So cash stayed about a little lower, not too different. So cash is 52 million. So they lease out the properties. Okay. Here's the debt. They have quite a bit of amount of debt. So 52. They have debt of 1,839,631,000. Okay. It's a lot of debt. All right, cash flow. So this is the depreciation, amortization of those leases. When you have a physical object, you depreciate it. When you own like a software asset or a right to use something, you amortize it. Okay, so their cash from operations did go down. Part of it is that net income was lower. The depreciation rate was different, which is interesting. Equity and earnings of unconsolidated subsidiaries. Okay. So this is like minority. If you own a minority stake in another company, you don't have to include those in your financial statements. You just take the gains or losses that they have. It's almost like they get paid a dividend from those partially owned minority stakes in other entities. Okay. All right. So I formed kind of like an understanding of this business. So let's go back to where we're at here. Okay. Is this the right one? So let me value this kind of high level. So they're supposed to keep growing. That's good. I want to look at one thing. Okay. So stock analysis, sometimes their data is off, right? It's missing a whole quarter. And that's why it's driving this 29% growth, is because it's missing a whole column of data in the prior year. So let's disregard that. They're growing single digit growth. That's what they're doing. I like stock analysis. They don't pay me a dime. I like how clean the website is. But every website, Yahoo, stock analysis, whatever, always validate your data, because those guys are aggregating it. And sometimes it's an error here or there. And you don't want to get caught up in using the wrong data. So their free cash flow came down. So this is 182. At their growth rate, this is worth about, call it 15 times free cash flow minus debt. This is not investable for me. And the reason for it is they have $1.8 billion of debt, right? So let's say I take this and I'm just going to round up to 200 million. I'm going to multiply it times 15. I'm going to get to basically $3 billion of value. But then when I decrement 1.8 billion, I get to roughly 1 billion of value. And these guys are priced at market cap of 1.6 billion. So this is just priced too high. They got a lot of debt. This debt is bad. See, this is somewhat correct, but it's incorrect. It's 1.8 billion. Debt to EBITDA 4.33. It's about that much. I like to stay under 3, which kind of symbolizes they can pay debt off in 3 years. Here it would take them more than 4 years. So this one here is a pass for me. If you think these guys are going to bounce back, you might make a few bucks, but boy, this is just going to be kind of you're buying a business that's never going to be like a great business, a really valuable business. You may see a nice 30%, gain, and you gain it just because it's so darn low price, 12.89. But you could also see what we've seen like with MPV, right? Medical's property and PW, excuse me. And this thing was so discounted. You think to yourself, well, if it could just get back to $20 a share, we're going to make a bunch of money. And it just kept going down and down and down and down. You're not in a high margin environment where you have a couple of good years and you paid off your debt and you're good to go. You're in a low margin environment. So no, thank you. I can find healthcare discounted stocks. I could show you, and I'm not exaggerating, 20 very nicely discounted healthcare stocks. So I'd rather go where the margins are better. I'd rather go where there's upside potential in healthcare, but this one's not the one. This one would be a hard pass for me. So hopefully you found that interesting. All right. ASML. If there is time, let's talk about ASML. So ASML is, I think it's the most valuable Dutch company that's publicly traded. These guys are somewhat of a monopoly because they put in the time, energy, capital, educated their employees to be able to manufacture these massive machines that are like the size of a bus, and they make semiconductors and they distribute them to foundries like TSM. And these guys have a market cap of 290. They have naturally a really strong moat. Revenues of 37 billion. Stock is up a little bit, 7.29. For the 1 month, it's flat. 1 year, down 19. And you can see that this stock has had just ups and downs. If you bought it at the right time, you're doing fine. But if you buy it at the wrong time, you're not doing fine. You're seeing a loss in value in your investment. So these guys have a PE that looks pretty rational, 26.42. 27.51 is the forward PE, 23% discount. Analysts say it's a buy. Here's what's strange is ASML, I follow it because it's so important. This is really good growth. And for some reason, the ASML management team and their earnings, they have these numbers and then they go, but we're not sure about the future. So their guidance is always really cautious and the market sells off the stock. And maybe the management team is right. Like, hey, you should be cautious right now. But that's what's causing the sell-offs. Fundamentally, it looks great. Look at these 4 quarters, all green, big numbers, looks good. So Um, so let's just use the numbers that they have. We'll see what these guys are worth. These guys do have some decent margins, 52%. Remember, we looked at Intel, they were around 50 when they were really strong. These guys are still really strong, 52% margins. Free cash flow, $9.2 billion. Beautiful number. And I like data that gives me a sense of trajectory, right? This data is sloping upward. Okay, we're good. We're doing well. This year here is because we had a huge sell-off in 22. There was a big technology bear market. So I give them a pass there. Now, so that looks good, 9.2 billion. Let's take a glance at debt. They have more cash than debt. That's what I'm talking about. They got like $4 billion of excess cash on the balance sheet. Very good. Excellent. So I believe I have a valuation on ASML. I used to have to delete my valuations from time to time because I used to have all these models in an Excel workbook. And you guys may know that Excel has a storage limitation and a row limitation. And I would have to kind of like trim back some of the data. But now I'm on Google Sheets and I don't think they have a limitation. So I'm going to just accumulate all the valuations I create and just create history. So these guys are fairly priced. And that's where I got to with these guys. Now, that's not compelling to me. I'd rather buy Qualcomm. It's discounted. And this is a valuation, I went through. I'm pretty sure I did a video. And right now they're fairly priced. If they could give me like a 25% discount, I would be a buyer because it's a quality business. It's an important business. But I want to make money. I want to invest and see my investment go up. It's just logical, right? I don't want to buy and then see my investment stay the same value. No, that's not the goal here. That rate, I'll just keep my money in bonds, make a little bit of income, and we're done, right? So ASML right now, it just doesn't give me that compelling proposition of, hey, you should invest in me because I'm going to give you a discount and I'm going to be worth a lot more. They have a valuation that's pretty high. 292 is not cheap, right? It's a pretty good valuation. And I think there's other opportunities within technology that are far better. Software companies have been sold off pretty harshly. Semiconductor is expensive. It's probably the most expensive industry you can look at. But if you go into software, get good discounted stocks, you can go into other industries and really find some great businesses that give me a better discount than 0% discount. So remember, what we're trying to do is we're trying to find great businesses. Okay, this is a great business. This is growing. Okay, that's great. We're 2 for 2. They have a good balance sheet. 3 for 3. Good business. No discount. Oh, okay, well, I'm going to wait. And maybe we have this harsh sell-off and maybe ASML gets priced down by the market. And then I waited and I bought it at the right time. That's what I'm trying to do. So that is my conclusion on ASML. Terrific business. I don't know if you guys have ever seen one of their products. Let's jump over to their website. These machines cost like $20 or $50 million a piece, and they're massive. Here we go. See what I mean? It's like the size of a bus, and everybody's in a clean room environment. That's what these guys make. Isn't that incredible? And these things create micro semiconductors. The semiconductors made today, right? Isn't it amazing that we can pick up our phones, right? And we literally have like a supercomputer in our pockets. And the way I look at it is back in the 90s when I got my first computer and I opened up the case, all the components were nice and big. I could get my big hands around the components and stuff. But these phones have these tiny little components. Well, they're super tiny because ASML creates these machines, and these things, they don't need human eyes and human sensors to make these semiconductors. They can make them far smaller and have these circuits be tiny, microscopic. That's how they do it. And they are able to compress the compute into this tiny, tiny little physical object. That's ASML. It's amazing. And these guys are the biggest company in the Netherlands. Something to be proud of. All right, we're rocking, and we got lots of comments coming in. I am joined tonight with one of my sons who's been monitoring the chat. Thanks so much, Evan. Appreciate it. Looks like Little Jay's on. What's up, man? Good to see you. Mitch, I appreciate the question. I appreciate you being on, Little J. So we're checking out ASML for Little J. Sam, good to see you. Thanks. So Sam might be our newest member of the channel. Welcome, sir. I think you made it to the Discord, and hopefully I see you out there. TSM is like a monopoly. I agree, because they have the capacity to make those semiconductors. ASML is like a monopoly. And I don't think governments are going to give them a hard time, because there's nobody ready to take on ASML's business. We would really destroy semiconductors if you just had anybody create these machines. These machines are so unique, important. The intellectual knowledge and advantages that ASML has, you can't make these companies, like, you just can't stamp them out. It's not like they're making shoes or something like that. That's far simpler. So I agree with you there. All right, so it looks like we covered Mitch's comments. Man, we got a lot of members on tonight. Thanks everybody for joining. Thanks for tuning in. And it's good to be with you guys. I'm going to be streaming a couple of times. I'm going to stream tomorrow morning with Daryl. And if you guys have attended the streams when I stream with Daryl, I do the fundamental analysis, and then he goes into technicals. And I love to listen to him because he kind of gives us a bird's eye view of what the market's doing with a particular stock, what kind of behavior. And on a day like this, when you have drastic sell-offs, I'm looking forward to talking to Daryl. Daryl, what's going on? Explain this volatility to me, please. And he'll do that. So it'll be really interesting. Tomorrow morning, 9 a.m. Eastern, if you want to tune in. And I'll also stream tomorrow night. And I'll stream probably each day for the rest of the week. So hopefully you can join me again. If there are folks out there that haven't joined the channel, let me just kind of mention it. We have a community of investors, long-term investors. We're 50 plus now. A lot of good ideas coming to the table, and you can be a member as well. It gives you access to the Discord, to member-only videos. I publish a couple videos each week, insightful on, the stocks that I'm buying, some insight that I would like to reserve to, for paid members. On live streams like this, your name comes up different when you become a member through my YouTube homepage, and you can put up stocks like you've observed here. A lot of the members put up stocks that I analyzed. And last, you get access to my research, my valuations, and some tools that I've put out there on a shared folder. So take a look. If it's something you're interested in, it's easy. Go to the home screen of the YouTube channel. You'll see a join button toward the bottom. And then it opens up the 3 different options that you can get signed up for, and see if it's something you'd like to do. So I think that's a good point. We've got to a good point there. Everybody have a terrific evening. Let's see if the market's going to be in a better mood tomorrow. And maybe we see some of these big caps rise. But if we see consecutive sell-off days, then you're really going to see the bad news machine get fully active through the news channels. Everybody's going to freak out if we have another sell-off tomorrow. Now, I'm not hoping for it, but you guys have heard me say for about a month, just be careful. August, September, October tend to be seasonally when we have sell-offs. And this is just one day.
But if we have a sell off, it's somewhat natural. It's not like, oh my God, let's freak out. No, let's focus. Let's focus and pick up those companies that we think are fantastic that are going to have better prices. Let's do that instead. Then we wake up 6 months from now making money, and that's the goal. So let's see what happens tomorrow. Thanks so much for tuning in. Everybody have a great night.